This Twin Petes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Petes Investing podcast. This is podcast number 93. It is the 25th of January. It is almost 6:30 p.m. in the UK. And my name is Peter Higgins. You can find me at Conkers3 on Twitter. And I'm here with my colleague, Wheelie Dealer, who you can find at Wheelie Dealer on Twitter. The markets have continued to be quite jolly, and I think Pete's pretty upbeat regarding the markets. Everything else is still very unhappy about, as we've spoken. But there's not much you can do about that. Pete, tell us what's been happening, mate. Come on,
mate.
Up to speed. Tell us about the good stuff first. Tell us about the positive stuff that you put in your jar. Come on,
mate. Before I do that, I've just got to say I've picked completely the wrong fleece tonight, because I look like a disembodied head. It's like I'm invisible. So I need to keep putting my hands up so people know it's not just a head floating on top of a sofa. Anyway. Oh mate, yeah. Well, I mean, weird market, innit? Weird market. I mean, there's a lot of things that are actually quite positive about the markets, and I'm thinking from a technical viewpoint. And the one that really hits me, and I commented about it on Twitter this morning, is that loads of companies, especially smaller companies, are coming out with ahead of expectations updates. Loads of them. I mean, today we had Hvivo, the one that used to be Open Orphan, totally surprised me, because I've been quite skeptical on them, because I do feel they haven't delivered in the past. And there's been some other sort of things that are a bit concerning, like a name change, which is something I rarely like. But fair play, they knocked it out of the park. And, I was wrong on that. They have absolutely done it. So I think that's brilliant. Ascential, ASCL, ahead of expectations. They're like a sort of data marketing events, whatever company, and they're doing a strategic thing. Conduit Re, CRE, they're like reinsurance. I actually mentioned them on the podcast ages ago, and they've risen quite nicely since. But again, they're well ahead of what was expected. Easyjet, EZJ, ahead of expectations. They actually said they're going to do a profit this year, which is like shocked everybody. I'm not sure about this one, but I think I heard JD Wetherspoon's, Tim Martin and all that, the pub thing was ahead, I believe. I might be wrong on that one. Hill and Smith.
That one today, I'm not sure.
Sorry?
I didn't hear that one today. I'm not sure.
Okay, I sort of like heard it on Ian King, I think.
Okay.
HILS, Hill and Smith. That's like a sort of galvanizing aluminium, sort of like like gutters and all sorts of stuff like that, and road infrastructure like Armco. They were ahead of expectations. Even Epwin, EPWN, which does like door frames, window frames, plastic, that UPVC stuff, ahead of expectations. And I think Lord's Trading, LORD, which is like a building merchants consolidator kind of thing, it only listed fairly recently. I think that was ahead of expectations as well. So I think we've had a situation where loads of management in agreement with analysts have massaged down expectations and sort of, because to be fair to them, they just didn't know. The uncertainty last year was so ridiculous. There was just no visibility of anything. There was a lot of fear around, a lot of woes and concern about recession, blah, blah, blah. So I think they came in with very low guidance, and they're beating it now. And we're getting so much of that. That is so positive for the market.
Yeah, I think there's been a few surprises over the past 3 and a bit weeks that we've been open. I'm not sure. Yeah, probably. I think you're probably right. The ahead, slightly ahead, marginally heads are probably ahead of the number of profit warnings we've also had, Pete, as the counterweight to that. Another company that came out this morning with because I put out a tweet for those that don't see it, that don't get up early enough. Betwixt 7 and 8, there's quite a few of us that put out RNS updates regarding stocks, including Pete myself. And I put out a small,
might come out later,
a small number. Yeah, a small number of about half a dozen, usually 5, 6, what I think are bullish tweets, bullish sort of RNSs as a tweet. And this morning, included in that was the ASCL one, Pete, that was up 26%. Wow. And the other one that was popping this morning was RUA Life Sciences, that I put on the bullish RNS tweets this morning, and that was up 26%, 25% as well today. Wow. So that came out with some really, really good news. But I think what we've got to be mindful of, and I think you're right, there might have been some people who being very conservative regarding what their views were of 2023 at the beginning, and therefore they want to surprise, which I don't think is a bad thing, to always play it down and then surprise. It's when you've got these companies that are talking it up all the while and then let you down, or let the shareholders down, of which, I've been graced with a couple of them already regarding profit warnings. But that's part and parcel of it. We want to have some upward surprises. So look out of a morning for bullish RNSs. There's usually about 5 or 6 stocks that I put out there. And if I'm fully awake, I might get most of them right, but there might be one that I've missed where the last line at the bottom of the whole of the RNS is like, we are going to breach covenants. I've missed all of that. So have a look in the morning at those RNSs that come out. But yeah, you're right. And I will talk about Hvivo a bit later on, Pete, because I want to speak about one of the entrants that we've got in the competition. Yeah. So we'll go back to the FTSE. Yeah, because I know that you've turned a bit cautious on it since it's started to roll over a little bit.
Only last few days, really, just as a sort of. Yeah. I think it's had a really good run at the start of the year. We're right up near the all-time high, which I think is 7905. We're just a little bit away from that. I think because it charged up so much, it's got to calm things down a bit, which probably means a little pullback or a bit of sideways. Ultimately, I think there's a very good chance that somewhere this year it will break out and will make a fresh all-time high. I'm pretty sure it will.
We need some good news for that. We're so close. It's like you can just go almost like that and get to your fingertips over. So the FTSE finished today at 7,744.8, just down 0.16%. FTSE 250 closed at 19,804, down 0.26%. FTSE All Share finished at 4,220. I always do this. 4,241, down 0.18%. And the FTSE AIM All Share still struggling, despite some fair bit of movement amongst the AIM 100. At 860.7, down 0.31%. So the markets are doing okay. I've been surprised, Pete. I think a lot of people have been surprised by the strength of January, given all the negative news that was priced into the market or being told to be priced into the market going into January. And we're going to have a really bad January, February 2023, full stop. And the strength of the first 3 or 4 weeks, I think, has surprised a lot of people who've been, we saw between September and the end of the year, less and less people talking about the portfolio. The first 3 weeks of the year already, we've seen far more people talking about the performance and the stocks and the shares. And so they should, because why not? Celebrate it while we can.
Oh, yeah. I mean,
last year wasn't so great. So to start the year with a nice positive bounce and nice feeling, then happy days, mate.
I mean, we talked about this on the last podcast, TPI 92, where we sort of said it's amazing how just a bit of positivity can improve your mood, and sort of it's so welcome. I just want to add that, so not only have we had the fundamental thing that loads of companies are doing better than the conservative expectations they guided to. The other really interesting thing is the technical picture across all major indexes. You look at the CAC 40, the French index, that is nearly at all-time high. You look at the Nikkei 225, that's at something like probably a 15-year high. I don't think it's quite at the all-time, but that was a bit of a sort of anomaly back in 1999 or something. You look at the DAX, that one has come off a bit, but it's again looking pretty promising. The FTSE 100 we know is near all-time high. The US indexes are interesting because my personal view is that the NASDAQ has put in a bottom in October last year. And I think we've now gone from that falling phase into a sideways range phase. If it moves up out of that range, that is so bullish, but I'm sort of not expecting that for some time. I can't see that happening. But I think overall, they look pretty good. The other really interesting thing, you mentioned AIM struggling. The amazing thing is the FTSE 250 is nearly doing a bullish 50/200 day moving average golden cross. It's right on it. The 50-day moving average has been sort of falling. If you're watching on YouTube, you can sort of just about see my hand. The 50-day moving average has been falling, but because of the positivity, it started to turn up, and it's cutting the 200-day, which had been falling, but is starting to level out. What we need to see is a 200-day moving average level out and then start turning up, which it's got a fair chance of happening at some point this year. Now, the really interesting bit is that with that kind of analysis, the FTSE small cap, I think, is the best looking index of all of them. That did a 50/200-day moving average cross thing. I think that's already done it. And the interesting thing is the AIM all share is also following a similar path. It's not as good as the small cap and the FTSE 250, but I think it's getting there and it's following the other two. So it's a really interesting time.
Yeah, I agree with you, Pete. I think for me, I've always viewed the FTSE 250 as the engine of the FTSE all share.
Yeah.
So if they start moving, and we see, like you say, ahead, slightly ahead, marginally ahead, and so on and so forth for the small caps and the FTSE 250, I think it will carry on building that momentum regarding the stocks. I think additionally as well, and we spoke about this before, is that there's going to be more takeovers within that space. So the better stocks within AIM and the better stocks within the FTSE 250 are likely to see the predators coming for them. So I think that's going to add a bit more weight going forward. And unfortunately, the weak stocks within the FTSE all share or AIM that have the audacity to come out and say, I'm really sorry, but we've missed this, or that's happened, or we've got rid of the CFO, we're going to restructure, they're going to get absolutely smashed. And that's what's been happening. The slightest sort of wording in that sort of RNS regarding a trading update, half year or full year, you're talking 25% shock, Pete.
Oh yeah,
25 to 35%.
Yeah.
And as I said in the last podcast and previous podcast, it won't matter whether you're a FTSE 100 blue chip dividend payer. If you come out and say the wrong thing, you will get absolutely smashed across the chin. And if you're a small cap, nano cap, AIM stock, your shareholders are going to be on the revolt, at the AGM. They'll be looking for, we need to get rid of this CEO, we need to get rid of this CFO, and the institutions will be looking to change things as well, or just completely sell all of their holdings, So going back to the NASDAQ you mentioned that was on the move again. The interesting thing is that, again, there's lots of negativity around the American markets pre-Christmas, and they've come out and surprised. Microsoft came out, with news about what they're doing. Some other companies came out, so a lot of them are reducing their workforce, which you spoke about before.
Yeah, the
but then
cost
Microsoft
base
came out and said,
yeah,
broke expectations, higher expectations for them, so their shares spiked this week. So that's good. All the negativity around Tesla, which I picked, and you went, "Oh, I'm not so sure about that." I mean, it's immaterial because the share price of Tesla doesn't matter yet until after the 1st of February.
Oh yeah.
But the share price already, Pete, is up 17% year to date.
Brilliant. Yeah, it's amazing.
Which isn't bad. So it's at 144 at the minute. But it's got to do the rising after the first, as far as my selections are concerned. You know what I mean? But the tech heavy sort of US markets have been boosted by the behemoths actually doing very, very well, Pete. So we will see. We've got quite a few numbers and data coming out this week and next for the American market. And as we say, if the American market's going up, invariably we get the nice positive vibes off that as well. So that will help us.
Yeah.
But once that starts rolling over again, we could be in trouble again, mate, unfortunately.
When you think about it, this comes back to what we had a guest. I can't remember how long ago it was. It was only a few podcasts ago. We had the secret accountant. Yeah, really interesting. And he said something so profound and so bang on the money. Right at the start of the podcast, he said, right at the start of the interview, he said things have a real habit of reversion to the mean. Yeah. So things that have moved too far to the upside tend to drop back. Things that have moved too far to the downside tend to recover. And it's interesting when viewed in that context. Last year, the FTSE 100 did pretty well, and the FTSE 250 and the small caps and the AIM, well, basically they were shite, right? Let's not beat around the bush. They were dreadful, right?
They behaved poorly, Pete. They behaved poorly.
That was the word I was looking for, the phrase. Yeah. But yeah, they were shite, mate. Anyway, the funny thing is, this year it feels to me like we might see the FTSE 100 not quite so as exciting, and the excitement is going to be in those small caps, the good small caps, recovering, and the ones that just got too beaten up, and the ones that are beating expectations. That's going to be the story. As you say, if you disappoint, you're still going to get your ass spanked, but that's the same any market, really. If you disappoint, you always get your backside whacked, as you should. That's how a market works.
Yeah, I agree. I mean, I agree with you there, because we saw so many FTSE 250 stocks and FTSE small cap shares and AIM stocks absolutely walloped. How many of those were minus 30% for the whole of 2022?
Yeah.
And if any of those come out with positive news and trend, they could really, really see some momentum. So those individuals that are out there, hello to you all. You might have a good 2023. So fingers crossed that happens. You know what I mean? Because it was like, it's like a barrel of a gun last year, mate. How many of them are going to get hit and kept getting hit? So yeah. So we'll see. But yeah, fingers crossed for them. Yeah, we will see, Pete. But yeah, I agree with you. We could have a good year. For the ones that come out with positive news, could be really good for them.
I think it's looking interesting. But one of the things to throw in is that on top of what we've just said, I'm still seeing a lot of value. We'll get on and talk about some other stocks later in the podcast, as we always tend to. But I'm still seeing big dividends. I hold Hvivo, right? AV dot, the life insurance and general insurance company. There were some fears that because Direct Line Group disappointed recently, there were fears it was going to hit other general insurers. But Hvivo came out with a statement today and said, we're doing all right, across our...
We're not as stupid as DLG. That's what they said. Our management is smarter than DLG's management. That's what they said, Pete.
Oh, so
Oh,
true.
gosh.
But the interesting thing with Hvivo is that, they're doing okay. Their combined ratio, which is what you need to look at in insurance companies, and you need it to be below 100. Their combined ratio is good, which means they're profitable on their underwriting. And they're paying something like 6-7% dividend even now, even after a flipping good run over the last year or 2 years, whatever it is. So that's a great example of where there's value. I'm sorry, I'm talking my own book there, but it's FTSE 100. I'm hardly going to move it, am I?
Yeah, but Pete, it's about sometimes, and we've said this over and over again, you can have two good companies in the same space, and the difference is the management and the execution of strategy. Yeah. And if you execute on strategy, you're going to outperform the other company that's the nearest peer to you. And that's what they've done, And who's managing Hvivo? A female CEO.
Some lady I can't remember the name of.
Female CEO, mate. So there you go. As I often say, sometimes, you've got to look at who the leadership is and give them the kudos that it deserves. Since she's been there, she's managed them extremely well, returned loads of cash to the shareholders, and executed.
Amanda somebody, I think it is, isn't it? Pretty sure it is, mate. Anyway, not to worry. Hello, Amanda, if you're listening.
Not to worry. Right.
Yeah,
so I want to talk briefly. I'm going to talk briefly, Pete, and remind everybody that we have started a new charity challenge, the Twin Petes Charity Challenge, and you can find that at the Just Giving page, which is justgiving.com challenge 23, which is on the pages. So it's just Twin Petes Challenge 2023 on the Just Giving page. And if you could all consider making a donation for the Memphis charity, that'll be greatly appreciated. It started, we've had one supporter so far out of the 2,500 people that have donated. I can't thank myself because it was me, but I would love for someone else to join me and make a donation. If any of you have listened to any of these podcasts before and have enjoyed them, any of you that have previously donated that would love to donate again, please do. Any of you that haven't donated ever, I would love for you to make your first donation to the Memphis Just Giving page, and let's get this show on the road regarding it. We'll talk a bit more about what they do and how they do it, regarding disabled young children, their families, and supports and services that they provide. And I'm hoping at some point later in the year, I'll be able to do something and invite some of our listeners to something in relating to Memphis in the year. That's my hope. That's my plan. Something similar to what I did in September 2021 is what I'm hoping, but it's all in the very, very preliminary stages at the moment, regarding putting something on for some of our listeners.
Mate, Pete, last year, actually, was it last year? It might have been the year before. You did exactly that kind of event. I think it was the year before. You did
September 21, yeah.
You did exactly that kind of event. And one of the companies that presented there was Open Orphan, ORPH, yeah. Which is Hvivo, which reported today and did really well. So it's a great opportunity when Peter has these kind of events to rock up, to have a pleasant evening, meet a few other investors, have the odd beer, I'm sure, but you might get your hooks into an interesting company, which loads of people obviously did. So well done to them.
Yeah. If we can get it sorted out, it's very early days yet. We'll sort of see what happens with that.
This is a quick hello to you, our valued Twin Petes Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
So sticking on the Hvivo one, Pete.
Yeah.
And moving on, folks, to the competition. Thank you all ever so much for your entries into the Twin Petes Investing Challenge. And I'm going to talk about a couple of stocks which have been selected here by one particular individual, and Pete's got a load, I think, that he wants to talk about as well. What we don't, and I think one of the beauties of this competition is that the interactions that we're already having from some of our listeners that just listen but don't necessarily interact with us, they're participating in this challenge / competition. And it's really good to hear from you all, because we know that you listen, but we don't often hear from you or hear from you at all. And one of the chaps that have entered the competition just sent his entry 2 days ago, I believe, is a chap called Alan McBride. So hi, Alan. His ticker Twitter handle is at FD Recruiting. So Alan has chosen Hvivo, Pete.
Excellent.
KDNC, which I'll tell you all about in a minute. Tech Capital, which I'm not going to speak about because I hold. TRD, which is Triad, and Centralnic. So I'll go firstly to Hvivo, which you've already mentioned there, Pete. Yeah. And as you rightfully said, it's formerly known as Open Orphan. And that's essentially a UK-based specialist contract research organization, a CRO. And it's engaged in testing infectious and respiratory disease vaccines and therapeutics using human challenge clinical trials. So that's the long and the short of it. The price rate.
Can I just add there? This morning, another company called ErgoMed, ERGO, came out with results. I've got a feeling what Ergo does is partly like Hvivo. I don't hold either of those, by the way.
Okie dokie. So the range on Hvivo is a low of 8.68 pence, September of 2022. The high was previous to that date, which was 21 pence in January 2022. Today, as you said, Pete, it popped on the news that it gave and surprised a few people. It was up 13% today and closed at 16.92 pence. So I'm not sure if it was down to David's tweet and me replying to him and vice versa, going on the conversations, whether that helped the markets, but it's definitely the RNS popped and got a few people's attentions this morning. So within David's 5-stock portfolio, mention I think you've mentioned this stock before now, Pete. Centralnic, which is a internet technology company. Yeah. Engaged in developing and managing software platforms, allowing businesses to buy subscriptions to domain names, websites, email, brand protection services, as well as tools for monetizing online traffic and acquiring customers online. So that's a nice little software, branding, tech, you name it, they're involved in it sort of play. So that could do well if more and more people are using the internet and websites going forward. And so that
the interesting thing on that one is that one of the directors is linked to Phoenix, some sort of investing group, and they've been buying shares like loads, almost like every day. They're just mopping them up all the time. So that's interesting.
Okie dokie. So the where am I at now? Scenic.
Yeah.
So the range for that price is 106.5 in July of 2022, and the high was recent, January the 12th of this year at 160, and it's currently at £1.42. And those shares are up 15% in the past 12 months. So that's one of Alan's picks. The other company I want to talk about in that one, before I finish on the last one, is Triad Group. And Triad is an information technology services company, and it's engaged in the provision of IT resourcing for both contract and permanent and consultancy and solution services. That's a mouthful and a half.
TRD, isn't it?
TRD, yes.
TRD,
So share price low recently on the 11th of January of 77 pence, and a high of 160 in February of last year. It's currently at 107.5 pence, and that's down 28% in the last 12 months. Do you know anything about that one, Pete? Triad, anything?
Well, do you know what? It's interesting because it's one of the quite rare ones that I don't really know that much about, and I'm quite.
That's fine. It's fine.
I'm quite intrigued because it's quite a small market cap, 17 million market cap roughly, and that's for me personally, that's probably a bit on the small side. It tends to be quite illiquid and whatever. But the interesting thing is, if I can finally get it up, I'm sort of playing for time here as I'm punching it into my SharePad screen to see exactly what the numbers say. But yeah, so looking on SharePad, actually, it doesn't give me what I was hoping for. I think, and I may be wrong, so people will need to check this out. I think the yield on it, the dividend yield, is quite promising. Yeah, it looks like it paid last year about 6 pence of dividend. So on a share price of, it's where I'm going to be doing some mental arithmetic. Share price of 107, 6p dividend, that's about 4.5% dividend yield.
Yeah, it's not
so
bad.
It's also, so you're picking up a nice dividend and you might have some capital upside as well. So yeah, interesting.
Yeah.
Small though, and
so
that brings risk.
Yeah, it's very small. I'm not going to talk about Tech Capital, as I said, because I own that particular one. And the last of his 5 is Cadence Minerals or Cadence Minerals, ticker symbol KDNC, and that is a UK early stage co that basically invests in the mineral resources sector. It's got various locations that it's invested in, raw earth, lithium as well, iron ore, from what I remember. Regarding that particular one, I may not have all the details correct on that one, so just check that one out. But it's an investor, early stage investment and development company, so it's got a few irons in the fire there. Share price low November 22 of 8.5 pence, a high of 27.7, and recently, today it was at 16.45. It's down 37% in the last 12 months. So there's an opportunity there. If they find and deal and produce and engage, and some of their companies that they're invested in deliver on the rare earth side of it, the iron ore side of it, or the lithium side of it, those shares could really, really re-rate very, very, very quickly. So that's Alan's 5 that he's picked. So thank you, Alan, for those 5.
Mate, looking at, I just had a very quick look through one of their updates, and for the way it read was almost like they have an investment company approach. So it's like Cadence sits at the top, and then there's other companies underneath. In a way, a bit like Tech Capital, TEK, that we're not going to talk about because you hold it. But in a way, it's similar to that, a sort of structure of like a group, and then loads of underlying companies. So yeah, it looks an interesting one.
They're basically trying to invest in undervalued, what they see as undervalued assets.
Yeah,
they put somebody in there, and they're trying to reinvigorate the company or get royalties from the company by taking a stake. So yeah, it's one of those that it's almost like a low risk approach, but the investments that they make have to deliver, if you know what I mean. You've got to choose the right projects to invest in. So if they do that, then they get a piggyback. So
really, you're backing the management. So if you can find out stuff about the history of the management and what have they achieved before, are they known to be experts in this field, then obviously that's going to stack the odds your way.
So there's a nice mix there within that portfolio of 5 for Alan McBride. So Alan, good luck with your 5, sir, and thank you for entering. And to reiterate to everybody that's listening to this is going to be going out, and I'm going to put it out as early as I can, Friday, if not late Friday night. Please, if you haven't entered this competition yet, reply to a tweet regarding this podcast, by the close of play, 5 p.m. GMT time, on Friday, the 27th of January. So we're going to put a new tweet out prior to lunchtime, if not earlier, regarding podcast 93. If you haven't entered the competition, choose 5 stocks. They've got to be UK listed, not AQX listed, US listed, not OTC listed, Canadian listed, not TSXV listed, and no Australian stocks. I'm really sorry. I know we had a few people that have chosen Australian stocks. Please go back and change them and reply to myself and Wheelie. I've tried to contact all of you that I know of, and Wheelie's tried to do the
I've
same.
done that, yeah.
If we've missed you and you chose an Australian stock, please reply to us and change that selection. If you made selections and you wanted to change them, and it's not an Australian stock and it's not a TSXV stock, you have to stick with the stocks you've already chosen. Pete, where do you want to go next?
Well, I'll tell you what, mate, I've got a question that I've wanted to ask you for about the last 2 years of podcasts.
Pete, you've asked me so many questions, mate, and I'm always like up with my guard going, what's going to happen here now? I feel like I'm going to get punched in the chin.
What is it now?
Honestly.
What is it now? Right.
Why are you asking me? Why do you think I'm going to know for?
Well, I don't know. But anyway, okay, here's a question for you. Have you ever used, what are your thoughts on advisory brokers? Now, give you some context. I only do execution only via online through the internet. When I know I want to buy something, I log into my platform, I say how many I want to buy, I hit the buy button, job done, jobs are good, and I move on. Yeah. But I know a lot of people use like advisory brokers, or I think that's the word for it. And you have like your own dedicated stockbroker kind of person, and you can ring them up and you can say, I want to buy this amount of stock or whatever, and they buy it in the market for you. Or if you want to sell, it tends to be a little bit more expensive. Is it called discretionary broker? I think it's another term for it. It's just something that I've never really done. I think a lot of our listeners would be interested in understanding the difference if you know anything about it, because I really don't. That's it, really. Yeah.
Yeah. I think the main one that people used to use back in the day was probably Barclays. Yeah.
Right.
The super wealthy used to use Coutts, which, if that's pronounced correct, Coutts, almost like the Royal Bank that people used to use. But the answer is no, Pete. I haven't ever used those brokerage firms. I've never felt the need to.
So you've always done it like me, pretty much. You decide what you want to do. You go online to your system, use your phone, whatever you do, job done, all over. Yeah, interesting. Yeah. Well, we'll have to find.
I think there's certain people that do that. I know a few people that use it, and it's quite good, especially when you go in and you want to buy a significant amount of something. It's usually quite good, to buy it in a tranche and they'll work the order for the whole day for you. Yeah. And sometimes I have to do that with the platforms that I use regarding the amount that I want to buy, and to sell in size as well. Sometimes helps. And there's nothing worse than when you.
How do you do that with your broker? Because what I find is sometimes I might want to sell some stock, and what I have to do is to put in like a limit order or whatever it's called, where I sort of say, I want to sell, say, 10,000 shares or whatever it is, and the lowest I'll accept is 98 pence, and then it goes through. And is that how you do it with yours?
It depends. You can do it like that, and on the occasions when it's difficult, this is the problem we've got, is liquidity problems, Pete. Depending on how small your stock is, and you will invariably see some people talking about their stocks and showing what they've done for the week or done for the day, and depending on how small the stock is, there's no liquidity, there's no shares actually traded in the stock. I can't buy a stock that doesn't trade on a daily basis, because one day there's going to be a time when I want to sell it, and because there's a certain volume of people wanting to sell at the same time, I'm last in the queue to get a sell. So it helps if you've got a certain relationship with the platform, and you're a good customer or whatever it is, to have those discretionary brokers that you can pick up the phone to. But equally, on the standard sort of platforms, you can pick the phone up. You don't have to always use the online. Online is a cheaper way of going about it. Yeah. But if you've got a sell in size and you want to sell just the once, or you want the order to be worked throughout the day, you have to pick the phone up. It'll charge. It'll cost you a bit more. Tell them exactly what you want, what bandwidth do you want regarding the share price you want to sell at, and leave them to get on with it. And see what happens, because that's invariably what I have to do sometimes when I have to get rid of some of my AstraZeneca shares. It's just not easy to do, Pete. Otherwise, you're doing that 4 times, 5 times during the day to get rid of stuff, and you think it's cheaper, but the share price is moving every single time you're doing it, and you're like, well, what's that? For those 5, 6, 7, 8 orders, you're paying for it 5, 6, 7 different times at £5.99 each or £10 each. You might as well have gone to the broker and picked the phone up and paid 50 quid.
Yeah.
And done it once at one price. So those that want to do that, I think it's a fine and fair way of going about it. Is it a required thing to do? If your portfolio is tiny, why pay £50, £60 a pop for each one?
Absolutely.
If you've got a portfolio over a certain value and it saves you a certain amount of money when you're getting rid of 250k's worth of stock, then it makes sense to have a discretionary broker or being able to pick the phone up and make that call and get rid of that tranche in one go and shave the costs off. The people are talking about, I'd use level 2 for this, that, and I get the optimum price by shaving a quarter of a penny off it. It's the same sort of principle. If you've got a big chunk of change that you want to shift regarding the share, with regards to paying a little bit more for a discretionary phone call to get rid of it or buy it.
Yeah, it makes sense. I'm pretty sure that IG Index for spread betting and they also do shares. I'm pretty sure they offer that kind of service, because they've often sent me emails and that and said, we got this guy who's your customer and manager or whatever he is or she is. I never speak to them, but they're there, So I think I know they do that kind of thing. But I think, as you said, I've had it before where I've had to sort of sell a chunk in a couple of bits during the day, and
and when the markets are busy or the markets are crashing, even especially when they're crashing, and you go online and you're thinking, I want to sell that particular holding or I want to reduce it, and you hit set and say, can't transact right now, and you go, and you see the share prices go like that. It's profit warned, and these people that come out at 8:01 saying or at 5 o'clock saying I sold on the bell, very rare you can actually do that unless you've got a really good platform that's got lots of liquidity and get rid of it for you. It's very rare you can get out at 8:01 in the morning, when the markets are tanking or that particular stock is tanking. No,
thanks, mate. I mean, I just like I said, I think it's one of these things that probably a lot of our listeners will have heard about, and a bit like me, not really know that much about it. So, maybe it's something we'll look into anyway.
It's there to be done for those that have got massive portfolios. The system's there to utilize it. I think one of the things I would say with regards to those sort of companies is to check out. Again, everyone's checked out every single platform there is to find out the cheapest sort of online platform. If you're thinking about sort of brokerage discretionary sort of one where you speak to the individuals to work the orders for you, is again, get yourself a little spreadsheet and work out which ones are the best value regarding execution, but also regarding costs. Some of them are more expensive than the others. You don't have to go to Coutts and spend a fortune on it. You could maybe find somebody that's cheaper.
Yeah, that makes sense. Something I did suddenly think of then is I believe some of them will actually sort of give you an element of advice and guidance, but I'm not totally sure about it. So I think
some of them will, and again, you have to pay for that, Pete.
Yeah. Say for instance, you rang them up and said, I want to sell this share I've got. They might say to you, well, that's not a very good idea, because they know that something's good, that they might say to you, well, it might be an idea for you to stay in that. So I don't know. I mean, I'm just we're not financial advisors. Advisory
brokerage.
We're not financial advisors. So if people want to know about these kind of things, they need to look at
need to look into it.
Yeah, but I just think that's the sort of thing. Mate, have we got time to discuss something else?
Go for it. Yeah.
Mate, quick one for you again is I've recently
Stop picking on me. Oh my gosh.
I've recently tripped over return on capital employed, ROCE. And to be honest, it's something I've known about forever, but I've never really taken much notice of. And so I've sort of like determined to look a bit more into it, see if and how it does help with my investing and whatever. And really, I'm just saying to you, have you ever really used return on capital employed much? And what's your what's your take
all the
on
time.
it?
Absolutely, all the time. For me, Pete, the essential thing is, to use the layman's term, you're looking at the margins. So for every pound invested, you're looking at that. They're investing a pound, you want them to make some money on that pound of investment. They're investing £1 million, you want them to be making 10, 15, 20% on that. Yeah. That's what you want. They've invested that. What's the gain on that investment? That's what you want. And the bigger the margin, the bigger the number, the bigger the percentage, the better it is that that company is actually delivering on what they're investing. On the capital they're invested, you want them to be making 10, 15, 20, 25%. And that shows you the strongest companies that are out there. The weaker companies are making wafer thin margins. I'm not saying they're weak per se, but the sectors that are weakest make the lowest margins as well.
But so, we're not talking necessarily here about profit margins, are we? You're talking about really the
return on capital margin, the return on the capital, on the capital margin.
Which is different to gross profit margin or net profit margin.
But I'm using the layman's term as margin, Pete. The invested capital, right, is that you want that much bandwidth from that capital invested to what they return to the revenue.
Absolutely. I'm with you. But interestingly, the profit margin does have a relationship.
It's something separate. I'll just use the term. Don't get lost on that. I'm just using the word margin, so people can understand it. But I'm going to say, you want the return on the capital. The return on the capital. So you want plus on top of whatever has been invested.
Absolutely. So as I understand,
talk layman's term and not complicated for those that haven't understood it.
So just to sort of give some more color around it, from what I understand is that using a bit of debt and using debt well can help boost your return on capital employed. If you've got too much debt and you're paying loads of debt interest, then that's probably going to hurt your return on capital employed. And it's just things like running the business efficiently, being in a good competitive position where you've got a moaty business and you're able to fight off your competitors. You can have higher profit margins, and that relates to a better return on capital employed. And there's other things like the stock turn ratio. So it's like when you buy some goods, you buy some goods in that you're going to resell. If you're doing that many times a year, your stock turn, you're doing it several times a year, you're going to do better in terms of the return on capital employed. The company that buys something and they only turn it over 1 or 2 times a year. So it's at the rate of stock turnover.
You're right. You're right, Pete. But I'm just trying to keep it simple here. Right?
No.
And all I'm saying is that it's regarding the company's profitability. Right. And how efficiently, capital efficiency. Right. You want them to invest the money. Right. The best companies invest amount of money and they make a good return on it. And it shows their profitability. So the higher the return on capital employed, the better and the more efficient the company is. And that's what you want. You ideally want a company. I think we had Simon on here, a brilliant leader, and I think he uses a ROC of 15% as a more than 15%. And the ones that are in that sort of basket of plus 15%, he starts to look at them. Some people will have 18%. You don't want something with 0.3%, because once the debt gets kicked in or something else goes wrong or one order gets delayed, they're on their knees, which is what happens
Yeah.
often with the construction companies, because their margins are between 3% and 7%. Something goes wrong, and all of a sudden they're getting the material cost goes up. The margins down to 3% and 5%, and that's how we lost Carillion with the black hole and all the rest of it.
Yeah.
You know, with all the debts that didn't get addressed. So you want a ROC 15% higher, 17%, 18%, and the rest.
Yeah. And I suppose we're looking for a certain consistency. So you want a company that's sort of got a history of doing, say 15% ROCE, then it might have done 17, then it might have done 13, then it might have done 20. But it's sort of all in that area, and it's fairly consistent. You don't want one that's doing. You don't want one that's doing a ROCE of 25 one year and then it's doing a ROCE of -4 the next year, and you don't want that.
You're invariably going to get some companies with lumpy sort of returns on invested capital.
Okay.
So you want a little bit of consistency, Pete, and I think the beauty of having the SharePad tools, plug for SharePad here.
Oh yeah, absolutely. Yeah.
Is that it will filter these companies out for you. Yeah. You can put those metrics in. You know, what's the return on capital? Yeah. What's the yield? What's the PE? You put all the different metrics you want, and it will just shrink it all down and filter it all out. You can even do it sector specific, you know, and have it all the construction companies, all the tech companies, you know, consumer staple companies, etc., and just filter them all out. So you've got the best return on capital employed companies, and then go from there.
Yeah. That thanks, mate. That's useful thoughts about it. And again, I think it's one where our listeners might find that reasonably useful.
And equally, just, you know, when in doubt, fire a DM to Pete and you'll ask me the question and see if I can answer
it. Yeah, exactly. You're
right.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Petes Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Petes offer is available to new subscribers only, and you can subscribe using the promo code TwinPetes. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Very, very briefly, I'm gonna plug the Investing Matters podcast, of which we had a fantastic guest, the previous podcast, which was Neil Shah of the London Stock Exchange, and we spoke about all things to do with IPOs and the IPO process. If you haven't found that podcast yet, please go and have a listen to it. Absolutely phenomenal sort of interview. And Neil does all the tech related stuff on the London Stock Exchange, and he's the director there as well. Really, really nice chap. And I'm hoping to speak to him again soon. I was in London on Monday with regards to something I'm sorting out with a company down there in London, and I met with Neil again relating to that. So I'll speak about that another time, depending on what happens with regards to that. And then the most recent podcast interview with Investing Matters is with Simon French, the chief economist for Panmure Gordon, who Pete also saw last week on Newsnight. And he's like, I've seen that guy somewhere before. Where have I seen him before? Yes, Pete. He was on Newsnight.
That was mad. I literally was watching Newsnight on like the Monday, and it said Simon French, whatever, and he talked a lot of sense. And then literally within like a day or two, Peter pops up and says, "Oh, I've done a new Investing Matters podcast, and it's got Simon French on it." I'm thinking, why do I know that name? Why do I know that guy? And then I remembered.
Yeah, he's an awesome individual.
I felt really sorry for Simon French because he was on there talking a load of good sense, and he was with another, I won't name him,
Careful
but
now,
another,
careful,
another,
Pete, careful.
another economist who didn't talk as much sense. Let's just say that.
I'm so glad I collared you just then. Oh, dear.
Right,
dear.
mate, can I do a shameless plug? I want to just say that loads of people are finding this podcast, Twin Petes Investing, for the first time. If you like it and all that, if you can hit the like button and follow us on, subscribe on YouTube and all that usual good stuff. But the other thing I would say is that all this stuff is free. It's no skin off your nose. So feel free to dig through the archive, because we've done 93. We've done 93 of these over time. You can hear the format of them. We talk about stocks. We do a lot of educational material. Go through and have a dig through the archive, because if you like this one, you might like those as well.
Agreed. I want to say a couple of things here to give people a heads up and a bit of a warning with regards to tech stocks, mainly those that are interrelated with advertising. Is choose your advertising stocks very, very, very carefully. Ad tech, advertising per se, because the latest data that's come out for Twitter, Elon Musk's Twitter, is that the ad spend since he's taken over, or is it since or for December? Is down significantly. It's down about 70%. So I'm not sure it's because of Elon Musk and Twitter, or it's a generalization regarding advertising space. But the stocks that are in the advertising space that you hold, that are US listed or UK listed, check them out, be prepared, have a good look at what's going on regarding other stocks that are similar, in a similar space, that are their peers, and have a look at your portfolios, ladies and gents, just in case you might need to get out before there's a warning in that space. If you know your company's strong and healthy and not going to be impacted by advertising spend, then great. But if you're a bit concerned, have a dig and be prepared to either reduce or whatever accordingly. Don't be left like me getting punched in the nose with a profit warning of 20-30% because the stock gets hammered with a profit warning that wasn't expected because the management hasn't said anything. And the last thing I'm going to say about American stocks is that there's still lots and lots of behemoth mega mergers going on, and I think we're going to see some mega mergers going on in this space as well. There's Apollo and Marcelo Clare are looking to take over Latin American telecom company called Millicom for around the high teens sort of price, enterprise value of about $10 billion. The market cap's currently 2.55 billion. It's up about 17% in America as we speak. Wow. But I think, and the reason why I'm mentioning this stock, this Millicom stock, is private equity again that's coming in for this company. They've got deep pockets. Those of us that have bought UK listed telecom related stocks, i.e. Vodafone, BT, and others in related to that space, have seen a really negative 12 months regarding those stocks. My hope for you, me, and other people that are holding telecom stocks, including, my overseas ones, Nokia, is that this could be, and hopefully be, some sort of move where people are seeing value or deep value in the telecom space and trigger some sort of phase of consolidation. So hopefully those of you that are holding BT, Vodafone, Nokia, etc., and others, see some share price movement going forward, because that space has been really poor for the last 12 months. So that's why I mentioned it.
That Millicom you mentioned is Tigo, Tigo.
Tigo, dollar sign.
I'd never heard of it. I've never heard of it before, and I even used to work in the telecom space, so that's like criminal.
Yeah,
really.
Latin America, mate. Latin America one.
Yeah, so, why would I know that? I just think of Telefonica for that. Anyway.
Yeah.
Mate,
so any other stocks you want to mention, Pete, before we go?
I'll tell you what, mate. I've got one to ask you about. Another question, mate. I saw a tweet from you this week or whatever. You'd sold Dark, DARK. Yes. What's going on there, mate?
No, I sold it. You said I dumped it, Pete, which was rather rude, I thought.
Oh, sorry.
You know,
Sorry.
you
No,
like, I just dumped it. I'm
you,
like, I
you,
just sold it. I just sold it.
you're
No,
too posh to have
in
a dump.
fairness, as I always do when I sell something, is I put out the contract note and
Yeah.
the reasons why I sold it accordingly. Essentially, I'd been in the stock for a while. I'd bought it in the threes. They had a takeover stuff last summer. I got rid of a load of it during the takeover because it was like ahhing about it. And then the last update was basically saying that going forward, there was possibly some delays regarding contracts, renewals, etc., and a slowing down of actual momentum regarding revenue generation. And I was like, this thing is going through so much grief. Yeah. And it's now sitting at nearer to 52-week lows.
Yeah.
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 And I'd put in my mind that after the takeover had not gone through, I wasn't going to allow it to go below my lowest buy price, right, which was in the threes. And here it was at the lows of twos. And I was like, you know what? There's better opportunities out there that are saying, actually, our sales have got better momentum.
Well, it's what we've
forward.
just been saying earlier, isn't it? That so many
in that space,
so many things.
So
I'd
already started building a position in a company that's in a similar sort of space to Dark, but not in exactly the same space.
Yeah.
And today I went and bought some more of that particular stock, having fully exited Dark. So I've not done a replacement for Dark, but it's in a similar sort of space. I like that particular space.
Yeah.
And those that know me and know Dark know that Dark are in lots of different spaces, but the main space that they're in is cybersecurity. And I've done a replacement for that. The other one I've got is in the US regarding that space. But there are lots of global cybersecurity companies, and I've purchased one of those, and eventually I'll share that name.
I really like that because to me, you know, I have a real problem with stop losses and selling ones like that. Yeah. But I must say that the idea of a switcheroo where you just keep it in the same sector, but you go from one in that sector to another in that sector, psychologically and all the rest of it is so much easier to do. So I really get that. And I think that's probably a good move. That.
It will be a good move, Pete, until they come out and warn and say, actually, we said we were doing well in November, and we've shot it now, and it gets spanked, you know. And if it gets spanked, I'll be sharing it with you guys. So we'll see.
Well,
you know,
I think Dark always runs that risk of having more problems, doesn't it? So I think you're probably better off.
I mean, the litigation thing hasn't gone away. The litigation stuff hasn't gone away. It's a company that I love. I think what they're doing with AI is absolutely phenomenal.
Yeah.
And that's the reason why I bought it. I made money regarding all of the transactions overall. Could have made more.
Yeah.
But it's just, I'm like, you know what? There's other opportunities out there. Let me try this one, and we'll see what happens from there.
Like you said, it's really interesting tech, but to me, it always had these sort of governance concerns around it. And I never liked the rating. It was always on this really, really high PE rating. And like we've said so many times, if you're on a really high rating and then you disappoint, you just get spanked. And that, to me, it was just too many things would put me off, you know?
Yeah, you got a high rating, you know, and profitability isn't as good as it could be. You can then opt for another company that's actually making profit with lower risk, with less cobwebs around it.
Less stress.
But equally, all it needs is a couple of bits of good news from Dark, and Dark will just go whoosh.
Yeah.
And as normal with me, the week or so after I've sold something, it starts to move higher. You know, it's just invariably what happens.
That's life.
You know.
Life,
so
mate.
yeah, so we'll see, Pete. We'll see.
Yeah.
But yeah.
I'll mention the stock. I don't hold it, but it's one that people are after income investments, you know, the dividend shares. One that might be interesting. It's a financials fund. So it invests in sort of banking stuff and related things. So I imagine it's got insurance and probably wealth managers and all that kind of stuff. So it's a financials fund. And that's City of London Investment Trust, CTY. Now, the reason that it's really leapt out at me. It has got, this is just stunning, right? It's paying around a 4.5% dividend yield currently. Yeah. It's got 56 years of consecutive dividend growth. 56 years. That's a 5 and a 6. Yeah, that's a lot of years.
Yeah.
That's nuts. That is nuts.
Yeah, it's what Annabelle Brodie-Smith and Nick Britton of the AIC have coined dividend hero.
Right.
Yeah, dividend heroes. And they just keep pushing on, mate. And this is what I was saying to somebody just this morning on a tweet I put out about the importance of total returns. And I think you put something out recently about it as well, Pete, about your overall income portfolio, how the bulk of that has doubled or whatever it was, the percentage return, and most of it was dividends compounded.
It was 60%, I think. I think 60% of the total return over 9 years has come from dividends. Yeah, unbelievable.
Yeah.
So important.
So this is what we keep saying about trying to find the right stocks you can keep hold of, and the advantage of investing long term. I'm just going to try and find this information that I put out about something.
Reinvesting those dividends.
So this is from the Wharton School in America, Professor Jeremy Siegel, a study of the period from 1871 to 2003. And he found that 97% of the total after inflation accumulation of stocks came from reinvesting dividends. Only 3% was achieved from capital gains, Pete.
Wow, that's mad. Yeah.
And I'm trying to see these numbers here. My eyesight's not great. So we're looking at total gains from that period, Pete, were $1,000 with total returns and dividends reinvested for that period that I've just given you the dates for, the years for.
What market was that for? Did you say the S&P 500?
S&P 500, mate.
Yeah. Wow.
The total returns. And for those years that I gave you earlier, £1,000 total returns and dividends reinvested. You've got 7,997,930 pounds, 7.9 million.
But you had to live to
over all that time. Yeah. I think the other thing that what did I say about that as well? Was about I'm trying to find it now. Can't find it. So sorry. And the S&P over the 100 years was that, what was it? Up until November, the historic average yearly return of the S&P 500 is 10.35% compounded, Pete.
Excellent.
Annualized return, including dividends, as I said, 10.3. Annualized return, including dividends, inflation adjusted, 7.2. Annualized return, no dividends, 6.28. And annualized return, no dividends, inflation adjusted, 3.27. And that was up to November of 2022.
Incredible.
So you can compound that for 100 years at 10%. How many times are you going to double your money?
Oh, it's amazing, mate. Wow.
Yeah. So it was just a discussion I was having this morning about trading versus investing. You know, some people like to trade stocks, get in, get out, and exit the market when they think the market's no longer going to go up, and jump in the market when they think the market's bottom. But you know, the conversation was being had. Billionaire old school investors, and they plucked 5 names out of the hat. Carl Icahn, Warren Buffett, Charlie Munger, Howard Marks, Nick Sleep. List of 5 billionaire investors. Blank, 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 blank. The second list isn't blank by accident. Why? Because there's no billionaire day traders.
Right. Yeah. Wow. Yeah.
So the long-term investors become billionaires, the very good ones that have got loads of money in deep pockets and were probably already multimillionaires when they started, become billionaires.
Yeah.
But even the day traders that start off as millionaires don't become billionaire day traders.
Wow. Yeah, that's interesting. Mate, I've got another stock if you want it.
Let me just check the time, mate. Let me just check the time.
Got time for one more quickie.
108. Make it quick, mate. Make it quick. Go on.
Right. I don't hold this stock, but I do hold one in the same sector. So this stock is Safestore, SAFE. I think the beauty of this one is you're going to get what we've just discussed, the idea of dividends that you can reinvest and whatever. The dividend is about 3%. Yeah. So the chances are you can buy SAFE, pick up 3% dividend. But the thing is, I reckon it's fantastic because you're going to get both. You're going to get the dividend, and hopefully that dividend will increase over time. They've got a very good history of doing that. But I reckon you'll also get good capital gain on top of that as well with patience over time. I used to hold SAFE, I don't know, 15 years ago, 12 years ago. But because I'm really stupid, I sold it, and I really shouldn't have done. And what's interesting about it is that, it's like, well, the one I hold is LOK, Lock and Store. So it's like BYG, Big Yellow Group. I'm pretty sure I've talked about this sector before on the podcast. So they do storage basically. So and the CEO of SAFE says something really good. He says all of life events increase the need for storage. If you're moving house, people need to put things into storage. If you're getting married, you need to put things into storage. If you're having a baby, you need to put things into storage. If you're going to university, you need to put things into storage. So all of life's events, people die, they need to put things into, well, they don't put them into storage, but someone does. So all of life's events, and there's all these events going on all the time, drive the requirement for storage. And if you look at the history of storage in the UK, it's massively underserved compared to America. If you've ever watched Storage Wars and whatever, but what's really interesting about SAFE is that they've got the UK ones, and they've always had ones in Paris and in France, but and they've done really well on both. But where it gets really interesting, they're doing expansion into Europe more. And when you look at how underserved Europe is, there's massive potential for storage to do really well in Europe. And I think they're doing it in Spain. I think they're doing it in Germany. I may be wrong on those countries, but they're expanding into Europe and using the same model they've used in the UK and in France and expanding it into Europe. So I think that could be a real cracker. Again, buy it, sit on it, be patient, let it do its thing. Don't get scared out of it. That's the mistake I made. I got scared out of it, or I made a bit of profit and thought I was a genius, so I sold it. And it's that classic mistake of selling too early.
That happens to all of us. But yeah, you're right. It's a good quality company. They've executed really, really well, and they've done it consistently. I think what's happened over the past 12 months is that whole space has felt the weight of whatever Amazon's doing. So a lot of them have been drifting down. So like you say, there might be value there now because they're a bit cheaper than they were at the latter part of 2021. During 2022, the whole sector sort of just drifted off a little bit, Pete. There's big box in that space, the warehousing side of it. Big Yellow, I think, is one of their peers, isn't it?
Yeah,
and a few others like that. So it's a good call. It's a good one to definitely go and research for people. Right, so I'm going to close with this and thank everybody for the feedback that we had for the last podcast. We are going to have some more guests. I'm going to sort that out going forward, so for you guys to have some other interest in looking at us too and listening to our dulcet tones going forward. So mix it up a little bit. So thank you all for your feedback. Thank you all for those that have entered the competition. Get your 5 in if you haven't chosen your 5 already by Friday the 27th at 5 p.m. Please just choose your 5. Reply to a tweet from Wheelie or myself regarding the new podcast. Reply to that new tweet regarding the new podcast and tell us what you're selecting so we don't miss it. And once again, just a last plug, please visit www.justgiving.com, Twin Petes Challenge 23 for the Memphis Challenge. And please make a donation if you can afford to do so, and just allow us to help some disabled children and their families. Until then, take care, God bless, stay safe. And those of you that have commented and replied to me regarding via DM the jam jar, good luck with your 2023. I hope you have lots and lots of positive, great memories to put into your jar, and stay strong, those that are having a difficult time of it. Take care, God bless, and see you in 2 weeks' time. Pete?
Bye. Thanks, everybody. See you next time.
All right. Bye-bye, guys. Bye-bye, ladies, gents.
This Twin Petes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.